What is RO in world of investing? Is it really a defining metric to pick winners in the stock market? In the world of investing, return on equity, or ROE, is a buzzword for fund managers, analysts, managements. A high RO is used to build a favorable investment case for a stock. Have you wondered how and why it matters? And is it really a defining metric to pick winners in the stock market? Here is some food for thought. An analysis of returns of Nifty 100 stocks in the last 5 years indicates that stocks ranked higher based on their ROE 5 years back, FY19 ROE, underperformed those ranked lower. The average return of the bottom 10 stocks, in terms of ROE in the last 5 years, at a CAGR of 52%, significantly outperformed the top 10 stocks that gave average returns of a mere 16% CAGR. What's amiss? Basing decisions by giving high weightage to a single metric is like holding on to one end of a rope without checking whether the other end is tied strongly or neatly, or whether it is tied at all. The other end of the rope here is price/book. ROE is nothing but net profit/book value. It indicates the annual returns generated on the book value of a company. So, if a high ROE stock trades at a high price to book, then it is already priced into the stock and there may not be much value left for investors to capture. This has played out in some of the high ROE stocks of 5 years ago. For example, stocks like Hindustan Unilever, P&G, Godrej Consumer Products, Marico and Britannia, which were in the top decile, have underperformed Nifty 100 in the last 5 years. The key thing to note here is that if you buy a stock with a high ROE of say 50% at 10 times price book, your ROE, that is the return on price you paid, comes down to a mere 5%. Thus assessing ROE against price book, that is ROE, PB, or in other words, assessing the stocks based on the earnings yield, which is nothing but the inverse of PE, has turned out to be a relatively better metric to pick stocks. For example, close competitors in the IT space Infosys and HCLTech had the same ROE in 2019. But HCLTech with earnings yield of 7% then as against Infosys's 5% has outperformed by a wide margin. The other point to note is that the presence of stocks such as Adani Green in the bottom decile of rankings both on RO and earnings yield makes the data look better. Excluding Adani Green results in ROE ranked returns of just 27% CAGR for the bottom decile, but still much better than the top decile. Making good use ROE is a useful metric that helps screen for businesses with high capital efficiency. However, one needs to check how strongly the other end of the rope is tied. Successful investing covers multiple factors and ROE may be a factor, but overstressing on it may yield suboptimal returns. Subscribe to our channel and don't forget to hit the like button if you enjoyed this video.